And joining us now to talk more about the markets this morning, Gabriela Santos is JPMorgan Asset Management's chief market strategist for the Americas. Good to see you again.
Good to see you.
So, I mean, right, this week it's been a story of UNH and then everybody else. I mean, there are people saying it should be booted from the Dow over this, which would be a little hasty. But what's going on under the surface? I don't mean there. I just mean with the markets more broadly.
So I think within the markets, there was a substantial lowering of the policy storm over the weekend. With the agreement between the U.S. and China, we feel like we have a better understanding of what the equilibrium could be here. With tariffs, we're at about 14%. We think that could be a good ballpark. It's something that's not overly disruptive, although it is, 7 times higher than it was at the start of the year. So now we're pivoting. I think the market narrative is pivoting to the next 100 days, where we're seeing elements that are more friendly to economic growth and to the equity market, including tax cuts, which is going to be the big topic going forward, as well as movements on the deregulatory front.
Let me ask you about on the tax. So this is the big kind of debate that's taking place, right? Why is the 10-year at 4.5%?
So
is it a good 4.5%? Is it a bad 4.5%? If I'm the Treasury Secretary Bessent loved when it was at 3.90.
Oh, yeah.
And he's often said his job is to be he's a bond salesman, and he's out there to sell the world on America's debt. So, we're past the sell America sort of climax, it seems. Why are yields still under pressure?
So I think it's a better environment for stocks and risk assets. I think it's going to be a more challenging environment for yields and duration, and especially the long end of the curve, which has been volatile for really the last 2.5 months. I think the initial move higher in yields was for good reason, lower recession odds, which is great, less reason for the Fed to cut rates for the right reason. From here, though, I think it's going to be all about what happens with the tax goodies included in the reconciliation bill in Congress. Because if we think about the extension of the Tax Cuts and Jobs Act, that's expected. That was baked in back in September when we saw rising odds of a Republican sweep. But the tax goodies included in the bill are between $1.5 and $2 trillion more than what was expected by the market. I think there's still some hope that maybe it gets scaled down as it goes through the remaining committees and then the Senate.
Right, but
but that's a lot that needs to be priced in.
But if it's 3.7 trillion or whatever the number is now, isn't that a little bit less in size than the bond market was fearing?
So the Committee for a Responsible Federal Budget scored it at $5.5 trillion.
Oh, did they?
So it's $3.5 trillion just to extend the Tax Cuts and Jobs Act. But that's not the only thing included. You've got an increase in the child tax credit, an increase in the deduction, no tax on tips or overtime.
Keeping a lot of the IRA breaks. Yeah.
There's a lot. And that's good in the sense that it for now, is written to start this year, 2025. So help and offset to what could be some of these still tariff headwinds. However, for the bond market, that's something that we need to understand what's the right term premium for that. What's the right extra amount of yield to compensate?
And someone made a great point the other day when we were sort of going on about this. They said, well, the 10-year yield was at 5% in 2001 or whatever. We were practically running surpluses.
Yes.
So who's to say that what 4.5% represents? Now, we all know it's a challenge because the deficit's so much bigger, the debt's so much bigger. But is it at 4.5% because of those factors?
So I do think if we think about the starting point, it is substantially more challenging. We're coming into this with a 7% of GDP deficit and a debt level that's already the highest since World War II. So you're adding $5.5 trillion to the primary deficit. Then you have to add the interest payments on top of that. So you can see how the trajectory for the deficit and the debt goes up.
Huge, yeah.
We're not here to say by any stretch that we need to see yields pop 200 basis points for that. We do think 5% was a good ceiling in October 2023 when we saw that. Just that it can get a little choppy as we understand what that is. Now, this morning, there were some interesting headlines that could perhaps help offset some of this. This idea of a rethink this summer of the supplementary leverage ratio for banks, which could allow them to hold more treasuries without being penalized.
That's
and could help
hinted at by, I think, Bessent, maybe even, I think Powell has said.
It's the Fed, the FDIC, it's all the agencies behind the support because it helps with the intermediation of the treasury market.
But it's just funny because on some level it's like, you know what, why don't we relax the supplemental leverage ratio that came about after the financial crisis to make sure I think that there was at least like a minimum amount of capital in banks. But it's like, well, if we relax that now, they can buy more treasuries.
It can help the functioning because
and you're like, well, okay, yeah.
Because it's not just the level of the 10-year, but also how crazy the movements are. And if we remember in April, at one point, the 10-year popped 35 basis points in a few days because you had an unwind of all these levered positions and you didn't have banks intermediating like they used to before the financial crisis. So I think just with the smoothness of the functioning, that could help. But in our view, it does mean a steeper curve, more volatile long end. And so when it comes to the bond market, we're focusing more on the core, kind of the intermediate duration, 3 to 5 years isn't bad. It's not a bad income duration trade-off to compensate still some of that risk exposure in the U.S. and overseas.
Avoid some of the longer term. Gabriela, didn't mean to do a whole bond market deep dive. But
I loved it.
You know.